Okay, imagine you're at a buffet. Because who doesn't love a good buffet? You wouldn't just pile your plate high with only mashed potatoes, would you? No way. You'd want a little bit of everything, some salad, some protein, maybe some pasta, and of course, dessert. Diversification is the same idea. It's about spreading your investments across different asset classes, sectors, and even geographies to reduce risk. The importance of diversification. Why is diversification so important? Well, it all comes down to managing risk. Different investments perform differently under different market conditions. When one investment is down, another might be up, helping to offset your losses. If you only invest in one stock or one sector, and that stock or sector takes a nosedive, you could lose a significant portion of your portfolio. But if you're diversified, the impact of any one investment's poor performance will be much smaller. Think of it like this. If you're building a hockey team, you wouldn't want all your players to be goalies, would you? You'd need a mix of forwards, defensemen, and goalies, each with their own strengths and weaknesses. A diversified portfolio is like a well-rounded hockey team, capable of weathering any storm. Asset allocation strategies. So, how do you actually diversify your portfolio? It starts with asset allocation. This is just a fancy term for deciding how much of your portfolio to invest in different asset classes, such as stocks, bonds, and cash. Stocks are generally considered riskier but have the potential for higher returns. Bonds are typically less volatile than stocks but offer lower potential returns. Cash is the safest asset class but provides the lowest returns. The right asset allocation for you will depend on your risk tolerance, time horizon, and investment goals. A common rule of thumb is to subtract your age from 110 to determine the percentage of your portfolio that should be allocated to stocks. So, if you're 40 years old, you might allocate 70% to stocks and 30% to bonds and cash. But remember, this is just a guideline, and you should adjust it based on your individual circumstances. Sector diversification in Canada. Within the stock portion of your portfolio, you'll want to diversify across different sectors of the Canadian economy. As we discussed earlier, the Canadian market is heavily weighted towards financials, energy, and materials. But there are other sectors to consider, such as industrials, consumer staples, consumer discretionary, technology, and utilities. Each sector has its own unique characteristics and risk-return profile. For example, financials tend to be sensitive to interest rate changes, while energy stocks are influenced by oil and gas prices. By diversifying across sectors, you can reduce your exposure to any one sector's specific risks. For instance, in 2025, you might consider allocating a portion of your portfolio to renewable energy stocks, given the global shift towards sustainability. You might also allocate a portion to technology stocks, given the growth potential of Canadian tech companies. Geographic diversification. Should you only invest in Canadian companies? Not necessarily. While there are many great investment opportunities in Canada, it's also a good idea to consider international exposure. The Canadian stock market only represents a small portion of the global stock market. By investing in companies outside of Canada, such as in the US, Europe, or Asia, you can further diversify your portfolio and potentially tap into higher growth opportunities. You can gain international exposure through ETFs or mutual funds that invest in global markets. For example, you could invest in an ETF that tracks the S&P 500 index, giving you exposure to 500 of the largest U.S. companies. Just be aware of the risks involved, such as currency fluctuations and geopolitical events. Diversification is not about maximizing returns. It's about managing risk. It's about building a portfolio that can withstand market volatility and help you achieve your long-term financial goals. It's a fundamental principle of investing that every Canadian investor should understand and embrace. It might not be the most exciting topic, but trust me, it's one of the most important. In the next section, we will discuss top stock picks and investment strategies for 2025.